Welcome to another edition of Econ Updates, a bi-weekly review of economic events moving the markets. Hello, I'm Steve Taddie, Chief Economist with Hoyle Cohen Wealth Management. Now, who could have missed all the uproar when the credit quality of our United States government was downgraded from AAA to AA+, an abrupt slap in the face to the politicians who are playing a game of chicken with the debt ceiling limit. Now, this happened once before in 2011 over the very same issue, debt ceiling limit negotiations. Now, it later got upgraded to AAA again 3 years later in 2014. But for now, our lovely US government is at a AA+ credit quality. Now, that doesn't really mean a whole lot in the investment world because there really is no other instrument like a US Treasury for liquidity and safety. Now, on the CPI level, a data point that came out in the past week, it was an encouraging 2.4% annual rate. It was up a little bit year over year, but we talked about that in the last edition of Econ Updates, and that was due to the base effects, or where inflation was in July of last year. The producer price index, the measurement of manufacturing and corporate inflation, edged up a little bit for the month, but it seemed more like a bounce than a change in trend. The price for goods, which had been in free fall, bounced a bit, and the price for services, which had been edging lower, edged a bit higher in the past month. Raw goods experienced the biggest bounce, with the price of commodities in the background probably causing a bit of that rise. Now, productivity, which is a measurement of output per hour or output per worker, had a big month-over-month gain. And that's great for corporations because that productivity gain can mute wage gains. And with that, the employment cost index, a measurement of the cost of employees in the equation of business, dropped to about 1.6% quarter over quarter increase, which is a much more reasonable and much more digestible level going forward. Now, in the background, those commodity prices I spoke about impacting the raw goods in the PPI, if it continues, it may get in the way of this dovish Fed that seems to be rising out of the ashes of a more hawkish Fed. But for now, the rhetoric points to a pause for now policy from the Fed. And that is where we start the week. Thank you for listening.